Every one of us is searching for an effective yet straightforward way to start investing and grow wealth. The challenge lies in finding a method that works without being overly complex. In this guide, I'll introduce you to the 8-4-3 rule of compounding, a strategy I've used to grow my wealth significantly in just 4 years. This approach provides a clear framework for building wealth, whether you're a beginner or a seasoned investor. Understanding compounding, the foundation of wealth building. Before diving into the 8-4-3 rule, let's break down the concept of compounding for those new to investing. Compounding is the process of earning returns on your initial investment, then reinvesting those returns to generate even more earnings. Over time, this creates a snowball effect where both your principal investment and returns grow exponentially. For example, imagine investing $10,000 at an annual return of 8%. After 1 year, your investment grows to $10,800. Instead of withdrawing that $800, you reinvest it. In the second year, you earn 8% on $10,800, not just the initial $10,000. This cycle repeats. And over the years, your money grows far beyond your original contribution. What is the 8-4-3 rule of compounding? The 8-4-3 rule simplifies wealth building by focusing on 3 key elements. 8% annual return on investment, ROI. Aim for an annual return of 8%, a realistic and achievable target for most investors. This ROI considers both capital appreciation, which is the increase in the value of your investments, and dividends, which is income paid by some investments. Achieving this return requires careful selection of quality investments such as index funds, stocks from stable companies, or real estate investment trusts, also known as REITs. While 8% may not sound like much, over time compounding transforms this modest return into significant wealth. 4-year commitment. The rule emphasizes staying invested for at least 4 years. This time frame is crucial because it allows your investments to ride out short-term market fluctuations. Many people panic during market dips, but staying committed ensures you reap the long-term benefits of compounding. 3. Diversified assets. Diversification is key to reducing risk. The rule advises spreading your investments across 3 asset classes. For example, stocks, shares in established companies such as consumer staples or tech giants provide growth potential. Index funds. These offer broad market exposure and are ideal for steady, long-term growth. REITs. Real estate investment trusts give you exposure to real estate without needing to buy property. Diversifying reduces the risk of losses. If one asset underperforms, gains in the others can offset the impact, keeping your portfolio stable. Applying the rule real-life example. Let's take Alex, who has $15,000 to invest. Instead of keeping the money in a savings account earning minimal interest, Alex decides to follow the 8-4-3 rule. He splits the $15,000 equally among stocks, index funds, and REITs, investing $5,000 in each. Assuming an average annual return of 8%, each investment grows to approximately $6,800 after 4 years. In total, Alex's portfolio grows from $15,000 to $21,000 in just 4 years, a significant gain. Now, let's say Alex adds a disciplined approach to this strategy by contributing $500 monthly to each asset over 4 years. By the end of the period, his total investment grows to over $102,000. This example highlights the incredible potential of compounding when combined with regular contributions. Here's how you can put the 8-4-3 rule into action. Start early and stay consistent. Time is one of the most critical factors in compounding. Starting early allows your investments more time to grow, even if you start with small amounts. For instance, investing $100 monthly from age 25 to 65 can grow to over $300,000 with an 8% return, far more than if you start at age 35. Consistency is key. Make investing a habit, just like saving for any financial goal. Automate your investments. Life can get busy and it's easy to forget to invest. Automating your contributions ensures regular investments without requiring constant attention. Use tools like robo-advisors or automatic transfers to investment accounts to make the process seamless. Reinvest your earnings. Instead of withdrawing dividends or interest, reinvest them. This simple step accelerates the growth of your portfolio. For example, reinvesting a $1,000 dividend at an 8% return over 10 years can grow it to over $2,000 without any additional contributions. Diversify your portfolio. Diversification spreads your risk across different investments. Instead of putting all your money into one asset like stocks, allocate funds across various classes. This reduces the impact of poor performance in any single asset. Diversification protects your wealth while maintaining growth potential. Focus on quality investments. Quality over quantity is a mantra that holds true in investing. Avoid chasing high-risk, high-reward opportunities. Instead, choose assets with solid fundamentals, reliable cash flow, and proven growth potential. For example, focus on companies with strong financial health and competitive advantages or REITs in stable markets. Stay disciplined and patient. Investing is a long-term game. Market fluctuations are inevitable, but staying disciplined helps you avoid impulsive decisions driven by fear or greed. Remember, it's time in the market, not timing the market, that builds wealth. Stick to your plan and let compounding work its magic. Stay informed and adjust as needed. Regularly review your portfolio and stay informed about market trends. While it's important not to chase fans, adjusting your strategy as needed ensures your investments remain aligned with your goals. The beauty of the 8-4-3 rule lies in its simplicity and effectiveness. It's not a get-rich-quick scheme, but a reliable strategy for building wealth steadily. By combining realistic returns, time, and diversification, the rule ensures consistent growth without taking unnecessary risks. Whether you're just starting your investing journey or looking to enhance your strategy, the 8-4-3 rule provides a clear blueprint for success. By focusing on realistic returns, long-term commitment, and diversification, you can harness the power of compounding to achieve your financial goals. Investing doesn't have to be complicated. Start small, stay consistent, and let the 8-4-3 rule guide you toward financial freedom. Remember, the key is not to wait for the perfect moment, but to start today.